FIRELife.
Hey, welcome back everybody to my channel. I'm your host Angel, Coach Angel here. Today we're going to be talking a little bit about insurance, life insurance to be exact. So I'm going to give you some of the basics about life insurance and there's a lot of different terminology and a lot of different types of insurance and different factors and scenarios about who qualify for insurance and whatnot. So some of these you might be familiar with, others you may not, and we're going to try to just go through some of these fairly quickly just to give you a good overall breakdown of life insurance and how things work out. So probably one of the main and most important things is who can qualify for insurance and how you qualify, or your ability to qualify could also affect your cost. And so there's a few factors you need to take into consideration. Right now, most anybody can get insurance. I mean, unless you're basically dying and they know that you're dying, unless you're going to pay a whole lot. So, and almost anybody can get insurance, but your cost may be really high. So maybe cost prohibitive. You may not be able to afford it. But there are definitely a lot of different options, and depending on the company that you choose to go with, they might actually be willing to take you on, even though let's say you've had a prior medical condition like cancer and things like that. There are companies that we work with that will take you. So it's perfectly fine. You could even have cancer right now and they'll still take you. So just because you've had past medical conditions or you're dealing with something right now doesn't automatically disqualify you. Just know that we can possibly help you. So it's always best to talk to a professional, get a second opinion, get a third opinion. Depending if they're a captive agent, let's say you go to your State Farm or some other company or whatever, they may not be able to because all they deal with is one particular company. So if you go to other companies, let's say, or another agent, an independent agent, or an IMO of some type, insurance marketing organization, they represent lots of different companies, and so they'll be able to basically compare and see which companies might be willing to take you. So some things to consider. Now let's get into basically what are some things that will affect your ability to qualify or the cost of your insurance. Probably the main thing is age. It's probably the most important thing. If you're above a certain age, you may not qualify for certain policies, or if you're too young, you may not qualify for certain policies. And we'll get into a little bit of that right now. So age is probably the biggest factor, what your cost is and whether you're going to be able to qualify. And next, obviously, is going to be your medical. So some companies are a little more risk averse. They may not be willing to take you on if you have had past or prior medical conditions. Or again, if you have certain things, maybe your cost just might be a little too high. But definitely that'll affect you. Another thing that might affect your cost of insurance is your credit score. Most people don't know that if you have bad credit, you have judgments, bankruptcies, and things like that. If they see that on your credit, that represents a risk to the insurance companies. So they might actually have higher premiums. Something to think about. Also, something that might affect your cost is risks. And by this, I mean, if let's say you're in a particular type of a job or an industry, a particular field, your costs may be higher, right? Because if you're a mountain climber, right, if you're taking unnecessary risks, some companies may not be willing to take you on. So that might disqualify you, or the cost will be high. Or let's say you're getting ready to go to the military or something like that. Your costs may go up because their risk goes up. So definitely something to think about. If you're over there base jumping or spelunking or whatever it is, you might be paying extra for insurance, obviously. And then there's also, depending on the type of insurance that you get and the different riders that you get. And a rider is basically like just an addition, an add-on to your insurance policy. Let's say I have a regular term insurance or some permanent policy or something, and I want to add a child rider. I want my kids to be covered. Let's say for 5, 10, 15, 20,000. So that obviously will increase my costs. And so there's a lot of different types of riders that you can include on your policies. Some the insurance companies don't charge you for, others they do. And depending on how insurance policies are structured, or with the different types of riders, could affect also the max death benefit you can get, obviously your cost of insurance. But there's a lot of different factors, including your MEC limits and things like that. Your MEC is a modified endowment contract. We won't necessarily get into that right now. We'll get into that in a bit. But yeah, so riders will affect or could affect your cost of insurance. All right. So let's get into a little bit about different types of insurance. There are basically two main types of insurance. You have term and you have permanent. Okay? And with term, there are two main ones, maybe three. You have your standard term insurance. Basically, that just means that it's for a particular term, a set time limit. And every year you renew it, and you might get a standard cost right throughout the life of the policy, and the term length, right? That'll be what you decide up front. It could be 10 years, 15, 20, 25, 30 years. There might even be some that, let's say, short term. Let's say you're going somewhere, or you need just some coverage for a short period amount of time. So you might even have policies that are maybe 1 through 5 years, and it renews every year kind of thing. So the length of the insurance will determine the type of permit is, right? And then there's also return of premium, ROP as it's called. And in return of premium, you might pay a little bit more for your insurance, but it will return. If you don't die at the end of your term, you'll get your money back. Now, for the standard term insurance, you pay for it up front, and this is the one that most people are familiar with. Very, very low cost for a high death benefit, right? That's because they know that it's going to only be for a short period of time. It's not permanent. It's not for the rest of your life. So the chances of you dying in 10, 20 years, depending on your age, is pretty low. And the insurance companies are very smart about this, okay? They have mortality tables. They know based on people's age and your sex. I didn't add that. You're also your sex. So male or female. That will also determine your cost of your insurance. But so they know based on your statistics, your demographics and whatnot, they'll know whether you're likely to die or not for that period of time while the policy is active. And so that will affect how much money, right, you might be able to qualify for. But the term insurance, if you don't die during that time, that's it. You lose your money. So most people, a lot of financial gurus will consider this what they would call a liability, right? You put money into it, but if you don't die, that's it. It's gone, lost, right? It's a sunk cost. Think about like your auto insurance, right? If you don't get in an accident, you don't file a claim, then you lose that money. That's it, right? And it renews every 6 months or a year or whatever it is. Term insurance is basically the same thing. If you don't die, then you lose that money. But you could have an ROP term insurance, return of premium, and if you don't die during that term period, then you get your money back, or at least some of your money back. So something to think about. Then you have your annual renewable terms. So again, these could be short terms. Every year it could be renewing. But now it might be cheap up front because you're young. But if you have an annual renewable term, it will likely go up every year that you renew because you're getting older. And so your likelihood of dying gets higher, right? So if you started out when you were 25 and then maybe from 25 to 30, it's very, very super low. But then once you get into 30s, right, it starts going up. When you get in 40s, it's even higher. In 50s, it's even higher after that. So definitely something to consider. If you only need a short amount of time to be covered, you can definitely go an annual renewable term. So there's renewables, there's convertibles, right? These can convert. You could put a convertible rider on your term policy, and you can convert it to permanent insurance later if you decide to do so. So that's something. And then they have decreasing, right? Or also what we might call mortgage protection. Now, mortgage protection, we've seen this be sold different ways, and it could be a marketing gimmick for some companies, but let's say you get a term insurance with mortgage protection or for mortgage protection. Let's say you initially get it when you first buy your home, and you might get marketed to during this time when you first buy a home. You might, all of a sudden, an insurance company might call you. And they might say, well, hey, you just got a policy, or you just got a mortgage for, let's say, $500,000. Why don't you get a policy to protect your mortgage in case you die, so that way your family doesn't have to worry about paying off the home. And every year it's going to go down. It's going to decrease in death benefit. So we'll cover you right now for $500,000. That'll cover your mortgage in case you die right now. But every year it's going to go down a little bit. And that way, if when you die, let's say after 20, 30 years, you don't need $500,000 worth of coverage because your mortgage should be paid off. So it's going to be decreasing every year. And typically your rate will go down, but your age is also going up. So it kind of balances out. But that is decreasing, right? A lot of times it's packaged as a mortgage protection. Now, in other cases, they might just call it a mortgage protection, and it's actually stays static. Whatever the death benefit is when you first got it, it'll be that same amount when you die. But it's typically for a period of about 20 years, depending on they might sell it to you depending on the length of your mortgage term, right? So if you got a 20-year mortgage or you got a 30-year mortgage, they might sell you a 20 or 30-year policy. Right? So that's something to consider. So that's term insurance. And some companies offer living benefits. We're going to go a little bit more into that, but they'll tack on some of these living benefits. So if you get sick, let's say you get a terminal illness, right? You're diagnosed in some terminal illness that you're going to die no matter what. The insurance company will say, well, hey, if you file a claim basically that, hey, the doctor gave me 12 months to live, whatever your death benefit is, let's say you have a $500,000 policy, you'll be able to actually get some of that money now because they know you're going to die no matter what. They're going to pay out the death benefit. So you'll be able to take, let's say, 80, 90%, depending on the company that you work with. So living benefits, we'll get into a little bit more about that. So that's term insurance. Then you have permanent, and there's different types of permanent insurance, right? And permanent just basically means that it's for life as long as you continue to pay the premiums, right? There's whole life. This is your standard traditional permanent insurance. And whole life can be a real downer, or it can have some really great benefits. If you're familiar with the infinite banking concept or becoming your own banker, whole life policies that are structured the right way could be a huge benefit. You could be really having a low cost premium of the cost of insurance and be able to still put in a lot of money into your policy and build up your cash value. Most of these all come with a cash value savings element to the policy. So you do get a death benefit, right? So you might get $500,000 worth of coverage, and you'll still be able to pay in a little bit more. So you'll pay the cost of the insurance just for that death benefit, but you can actually put a little bit more or a lot more so that you can build up cash value and use that later for taking out a policy loan, building up your death benefit so when you die, or you can actually tap into other types of living benefits like a lifetime income rider, where the insurance company will start to pay you out that cash value and some of the death benefit, let's say when you hit 65 for the rest of your year, so it could supplement your retirement income tax-free. And typically this is distributed through the use of policy loans. So the other type of permanent insurance, universal life, and there's two kinds. There's indexed universal life, or IULs, and there's also variable, or VULs. I'll get into this a little bit. Indexed universal life, basically what it is you have a permanent life insurance, and it is tied to, your cash value is tied to an index fund like the S&P 500, or there's, depending on the company you work with, they might have different funds that they tap into. Now, your money is not directly invested into the stock market. Basically, the insurance company uses some of that money, their own money, I should say, and they invest it. And depending on the returns for that year, for that index, and there's different ways that they measure those returns, point to point and some other things. I won't get into some of those specifics, but essentially, let's say the stock market, like last year in 2019, the S&P killed it. It was like a 24%, right? You might get half of that, let's say 12%. So your cash value could grow significantly, like you would normally have put it into, let's say, a mutual fund or something like that. But the insurance company obviously keeps some of those returns. That's how they make their money. So this is a great option for savings. Variable, your money itself, your cash value, you just basically decide, I want to invest this money into mutual funds or some fund or in policy, or stock company or whatever it is, and you decide where that money goes. The insurance company doesn't invest it, you invest it in whatever funds are available there. But it's variable, okay? It's directly tied into the market. So if the market crashes, market goes down, you could lose your cash value that you've putting into that savings element. So that is risky. So a lot more risk. Index is typically, for the most part, guaranteed. Okay, there is a 0% floor. In some cases, you might have like a 2 or a 4% floor, which means that no matter what, it's guaranteed, right? Not to ever go down below that. So in this case, if it's a 0%, basically whatever money you've put into it or whatever money has grown as the policy's been in the index, you're guaranteed not to lose any of your money. So no matter what, you won't be tied to the ups and downs of the markets. You'll maximize on the gains, but you'll have a floor. Now, typically they'll have a cap as well. Let's say they might be capped at 12%, sometimes 14%, depending on the company. But variable, if the market goes down 30%, right, like it did earlier this year in 2020 because of the COVID pandemic, a lot of people lost money in their variable policies. We typically stay away from this stuff. You have to have, if you're an insurance agent, you have to have a license for that, Series 666, to sell variable policies because it is tied. It's a security thing. You have to tie it into the market. So we focus on index because of the guaranteed thing. So people don't lose their money. Our clients don't lose any money. Right? During the pandemic, none of our clients lost money. It's a beautiful thing. Now, there's also other types of permanent insurance. Final expense. Now, this is typically for people that are 50, 55 or older, I think depending on the company. But basically, it's what it sounds like. It's for your final expenses. So there are usually limits. I think the most you might get 40, 45, 50,000 maybe. Typically, it's between 20 to 30,000 people might get. Or if you can only afford, let's say 10 or 15,000, it's just enough to cover your final expenses, so your family's not burdened with those costs. It is a little more expensive, obviously, for obvious reasons. They know you're going to die a lot sooner than if you were 20, 30 years old. So this is sometimes cost prohibitive, but it's a good option for you to get something, especially if you're nearing older age. But you have to be careful because if your cost is really high, if this thing's not structured right, you could actually pay into the policy, right? Your premiums every month could be more than the death benefit. So let's say you get it when you're 60. And you say, well, I'll get it for like 20 years, I might be dead by the time I'm 80. Well, no, let's say you live to 90. You would have potentially paid more for that policy than the death benefit that you would have got. Let's say you would have got 20,000. Let's say you're paying let's say over $1,000 for your insurance premiums. So let's say you live to 90, that means you would have paid $30,000 into it, but you only got a $20,000 death benefit. So there is some risk involved with that as well. So you have to be careful. You have to know what you're doing. Now, a lot of newer policies, and not every company offers these, but there are living benefits. There are some great things, right? So I talked a little bit about terminal illness, right? If you get diagnosed with a terminal illness, you could tap into your death benefit. The insurance company will give you money to help you live out your whatever time you have left on this earth, and that'll help you just kind of with your end of life situation, right? And you can focus on getting well or having some peace while you're passing. But then there's also other types of things: chronic illness, critical injuries, chronic and critical illness. There's various things in there. Say diabetes, or if you get a critical illness like where you are not able to fulfill, let's say, 2 of 6 basic daily functions, right? You're not able to feed yourself, clothe yourself, go to the bathroom by yourself, get to the bathroom by yourself, walk, things like that. So that will also pay you out a portion of the death benefit early on, so that you can deal with life. You can get extra care, you can get health or assistance while you're dealing with those things. Yeah, so some policies have those benefits. Some of the companies that we work with offer that. One of the companies that we work with, I won't get into the name right here, but they offer all four. So you all four, or it's the only company that has all four available in California. So yeah, some great options. And also critical injury. Let's say you get in an accident, and get your leg chopped off, or you're in a coma or something like that. They'll pay you out a portion of the death benefit, or they might have monthly payments for however long that you're incapacitated, right? But let's say you do lose a leg or something, or you become paraplegic or something like that. They'll pay you out a good portion of that death benefit, right? And they'll leave a little bit in there so that when you do die, at least you have something else. But you have to continue to pay the policy and whatnot. So living benefits are amazing. And again, the other big one is lifetime income. So depending on how the policy is structured, you can pay into the policy, let's say to your 65 or something, and then after that, right, hopefully you've built up enough cash value in there that whatever the cost of insurance is gets pulled out of your policy, out of your cash value. But then they'll start tapping into your death benefit and your cash value and start paying you out guaranteed income for life. So let's say you live for a long time, you live to 95, 100 years old, depending on the policy, they'll continue to pay you out. And they'll leave a portion in there, let's say to 15,000 just to cover your final expenses for your family. But you would have tapped into all of that death benefit throughout that lifetime, right? From 65 to 95 or 100. And so you get guaranteed income. Even if you deplete your death benefit amount, they guarantee that income will still keep coming in, right? Typically through the use of policy loans and things like that. So a lot of good stuff. Now, most people have life insurance, a group policy through their employer, right? Not through your job. But this group policy, you're not the owner of the policy. Your group, right, your job is the owner of the policy. So if you're covered, typically you're only covered for a certain amount. Your company typically would pay for that or whatnot. And they might only cover you for a small portion, maybe say a year's salary or double your salary. Now you can potentially buy a little bit more, but that's a separate term. But here's the deal with this stuff. Since you're not the owner, if your company decides to cancel their group insurance, like right now during the pandemic, they say, hey, we don't have the ability to offer that benefit anymore. So they might cancel your group policy, and that's it. You don't have insurance. And let's say now you want to go get insurance, and you might have been with your company for a long time, right? And now you're older, and you try to go get your own insurance. It's going to be a lot more expensive, right? Because of your age. And you might get a term insurance or permanent, whatever you want. But at that point, you are out. You have no coverage. And that puts your family in a lot of risk. So even though you may be covered by a group policy at your work, you should be getting your own policy. Because let's say, what if you get laid off or you get sick, you're not able to work anymore, or you decide to leave that company? There could be a gap between the next company that you go to that offers that insurance, and you won't be covered. And by the time you go try to get insurance, you might already be older. Let's say you're with the company for 10 years or something, and now you're going to go get insurance, and because of your age, it might be a lot more expensive. So it's important for you to have your own policy, because don't matter where you go, what employer you go to, you'll still be covered. So that's basically it. Those are the life insurance basics. I might do another video about annuities, which also is stuff that the insurance companies sell. But if you need help, if you need someone to talk to about insurance, you just want some information, reach out to us. FIRELife Financial. Okay, my name is Angel. You can reach me at firelifefinancial@gmail.com. firelifefinancial@gmail.com. And I'll be happy to talk to you about your questions. If you live in California, you're in Texas or Nevada, I'm licensed there, and we can help you with that. We do have other agents that we work with in our organization that can help you. So depending on what state you're in or whatever state you're in, we should be able to help you out. But it's always good to get multiple quotes. It doesn't cost you anything just to get a quote, get an illustration to see how much the policy works, what companies that they're working with. And the beauty of working with us is that we do work with multiple top A-rated companies that have been around for over 100 years, that have really strong ratings, that have a good balance sheet. They've been around a long time. They're not just going to go away. and we can, give you the best option for you, for your family. And we can compare multiple quotes. Now, most of the time you're going to go out there and you're going to see online, certain companies that they're just advertising at really low rates on there. And typically that's just some standard term insurance, right? And they might quote it based on someone who's super healthy and really young. So be careful of that. Just because you see a quote on TV for $15 for $1 million of coverage, yeah, it's probably a 20-year-old that's super fit, and that's why they're able to get that short term, because the insurance company knows that guy's going to live for a very long time, and there might only be a 20 or 30-year term, right? So, yeah. If you need help, reach out. We're here to help you. So with that, if you have any questions, reach out to me. Drop me a comment down below. Let me know what kind of questions you might have. Try to reach out to everyone. And go ahead and hit that like button. And subscribe to my channel. Be a lot more videos coming soon. And also share this video with someone you know, your loved one, maybe your spouse. Let them know, hey, we need to be thinking about life insurance, because guess what? Tomorrow's promised to no man. And you don't know. I mean, look at this coronavirus pandemic. Anything could happen. Life is short, right? People get in an accident. I've heard stories where an agent presented someone with a life insurance policy. They decide not to do it. A day later, 2 days later, dead in a car accident. Those are real stories. That stuff happens. You don't ever know when it's your time to go. So you better be prepared. You better make sure your family's protected. And that's the way we can help you. And especially if you're thinking about long-term, a way to supplement your retirement income, with a permanent policy with the cash value savings element, there's definitely a way we can do that. You definitely want to supplement your retirement income, tax-free retirement income. So something to be thinking about. You don't want to just depend on Social Security, because let's face it, Social Security, it's insolvent. 2035, that's it. The government says they're not going to have enough to pay out all their obligations. So you need to be thinking about ways for you to have passive income or some other income streams that can help supplement your retirement. You don't want to just be dependent on that. And if you have all your money in stock market and mutual funds and things, bonds and stuff like that, you never know. Things could go down. I mean, just like this year, right? We had a 30% clip. And if you're getting close to retirement age and all of a sudden a whole bunch of value in your portfolio goes down, you could be in a lot of trouble. So it'll take you a long time to get that money back, if at all. So definitely have other options here we can help you with. All right, with that, appreciate you all. Welcome. Hope you come back. I'm Coach Angel. God bless you.